Hi, Brian London here from the New Orleans Investment Conference, and I'm welcoming two friends of mine, Peter Schiff and Mark Skousen. Neither one of them exactly a wallflower of economic commentary. Guys, what's going on? We've had supposedly we've had a solution reached in Europe. They've come to an agreement, 50% haircut on the Greek bonds. Looks like everything's coming up roses, and we finally found a solution and can move forward. What do you think, Peter?
Well, first of all, Mark, you and I first met at this conference. That's what I met you, I think, about 1996. The first time we met, it was here in New Orleans. I wasn't even a speaker back then. I just was an attendee.
Wow.
Yeah, so it was back a while. But, I've been saying that I thought that Europe was going to put a Band-Aid on this situation. I think they've done it. I think the solution won't work long-term, but it'll work long enough to put the focus back onto the U.S. And I think at least to their credit, at least Europe didn't really follow our example. They're forcing the Greeks to take at least a 50% haircut. They're not making them whole like we did. We made the creditors whole in the bailouts. And I think there's going to be a bigger haircut because I don't even think Greece can afford to pay back half their debt. So I think more is coming, but at least the lenders are taking a loss. And there are some real cuts being made to government spending in other countries, particularly Italy. There was a lot of concern that Italy might be the next Greece. And so now they're doing reductions in government spending, some free market reforms. So I think Europe is acting because I believe the politicians realized they had no choice. Unfortunately, American politicians have had a choice. We've been able to borrow at near 0%, so we haven't made any of the hard choices. And as a result, we're in a much deeper hole now than we were a few years ago. And I think when the sovereign debt crisis comes to our side of the Atlantic, it's going to be really catastrophe. And it's going to happen in the currency market first, I think, and then the bond market.
Well, that's comforting. I thought you were striking an optimistic tone for a moment there.
Oh, no. If I did, it was by accident.
Right.
Well, I am optimistic. I think the Germans had a lot to do with this deal, especially with the Greeks and so on. And to me, it suggests that when their back is against the wall, Europe said, we can't let the European Union collapse. That was the ultimate concern here, to keep the euro intact. There's a lot of doubting Thomases whether the euro can even exist with these desperate countries involved, and they're desperate themselves to make it work. So I think there's a justification for this market rally as a result of this, and maybe even the possibility that the United States, the Americans, will look at this and say, look, they're acting responsibly, maybe we need to start acting responsibly as well, because our back is to the wall also in the United States, and we have to act. But listen, I've been around. I well remember the New Orleans conference in 1980. This is before your time, Peter. And, I almost became persona non grata by saying Reaganomics would work, sell your gold and silver, and buy stocks and bonds, because we have had a sea change here. And it didn't last forever, but Reaganomics was a beautiful thing of lower taxes and deregulation and controlling the money supply. All of the good things that came out of that is something that we could really learn from, and we're being forced to go in that direction. The only problem is we don't have a Reagan. If only we had a Reagan.
That's the truth. That's what scares me.
Mitt Romney is no Reagan, unfortunately.
We have the antithesis of Reagan. I mean, we're as far from Reaganomics right now as you can possibly be. I guess for this gold conference, I guess we don't have to worry about Mark turning bearish on gold anytime soon.
Actually, Peter, I will say that we have been taking some profits on our gold and silver position recently, and in fact, from a technical point of view, there's quite a bit of damage in that gold and silver market. It has not recovered from its previous highs, and if we go another year without it going above these prices of $1,900 on gold and $50 on silver, then that's your classic topping out pattern. And there's a big premium right now, crisis premium in gold and silver. And the question is, if we resolve some of these issues, that premium will have to squeeze a little bit.
I disagree. I think the technicals look really good. In fact, just even today's action, we've really broken out of some resistance in silver. I think we're headed back for those highs, and I think eventually $50 isn't going to be the ceiling; it's going to be the floor. We have a huge double top up there. there.
I have to agree a bit with Peter. I've looked at some technical evidence, and I'm sure you saw it in my presentation this morning, Mark. The charts I presented showing that it really has gone through a bit of a bottoming formation in gold, and that some things, Bollinger Bands, some moving averages are pointing toward a new rally. But you know, one of the things that you mentioned in 1980, Jim Blanchard at that time also caught some heat for predicting that Ronald Reagan was going to become the biggest spender in American history, which he did. Of course, he was supplanted by each successive president following that. But I did a chart in my presentation that rebased gold and federal debt back to 1971, the closing of the gold window by Nixon, and tried to look at that correlation. In the 1970s, it worked perfectly. In the 1980s and the 1990s, when we had Reagan with high growth, when we had the peace dividend in the 1990s, there was no correlation. Gold flattened out or dropped. But 2000, all of a sudden, debt was rising again, and gold took off.
Yeah, I think these are the cycles we talk about, and that's why the New Orleans Conference, which I've been at for 35 years, I mean, that is a bellwether of what is really happening in the world, and so I love coming to the New Orleans Conference as a result. But again, in 1980, the skeptics were there, including Jim Blanchard, who said nothing's changed with Reagan, and that's not true. Gold and silver went through a 20-year bear market starting in 1980, and I called that. I'm going to take credit for that, Peter.
Well, I don't know. I was
and I was persona non grata because,
but remember what happened. Paul Volcker had to put interest rates to 20% to stop that gold bull market. I mean, is Ben Bernanke going to do anything like that? He's already promised 0% interest rates for another 2 years. You know, if Ben Bernanke had been Fed chairman when Ronald Reagan was elected, you'd have been wrong on that call. The price of gold would have kept going up.
The primary drivers for gold, the way I always put it to people who aren't really intimately knowledgeable about the gold market, are money and debt. And we've got too much of both right now. And we've got a lot more money coming up to address that huge debt load. In Europe, that solution that they supposedly come up with today, is that going to be ultimately inflationary?
Oh yeah, absolutely. I mean, there's
so how can you be bearish on gold?
Well, it's always a question of how much inflation, particularly price inflation, consumer price inflation, and how much is involved there. I actually think interest rates are going to start rising here because that'll be an indication of return to normalcy.
Well, they already have started to rise.
And that's important because that is going to cut into the gold and silver bull market, which has enjoyed this incredible interest rates, in real terms, negative interest rates. And that could change.
That's only true, though, Mark, if rates actually get ahead of inflation. Even if rates are going up, but inflation is accelerating more, which I believe it is. I mean, look at the impact on commodities today with the weak dollar. Dollar hit an all-time record low against the yen today. It really got crushed against a number of currencies. That sent oil up about $3 a barrel. So inflation is going to get worse more than interest rates are going to rise. But again, the Fed, even if long rates are moving up, Ben Bernanke is still keeping the short rate down at 0. That is very, very bullish for gold. And in talking about whether or not we're going to do the right thing, Europe did the right thing, or a version of the right thing, because they had no choice. We still have a choice. We're not going to do the right thing until we have a crisis. And that crisis is going to come from a big drop in the dollar that really is pushing up long-term bond yields. And then what we have to consider is what happens to the U.S. economy that's so addicted to cheap money when those interest rates rise and all of a sudden interest payments on the national debt triple or quadruple. How do we handle that?
Well, we handle that because when the election comes up, my prediction is that Republicans will sweep the office in all 3 areas, including the presidency. You know, that's a big question mark as to who the candidate is going to be and if he's going to be strong enough against a very articulate president.
Remember what happened last time? We had the Republicans controlled all 3, you know, the president in both houses.
Right, but it's a different situation. It's the Tea Party and it's others saying, look, Republicans, you have to act responsibly this time around. They have a mandate.
There does appear to be some commitment to do something controlling debt, but there's 3 ways to attack a large debt load. You can cut spending, you can promote growth, or you can depreciate the currency or depreciate the debt away. It seems to me that with a debt load like we have in the U.S. as well as in Europe, that you may be able to do a little bit of the first 2, but you're going to have some degree of the third, and it's just a question of how much.
Well, that's right, especially Social Security and Medicare. All those have to be cut back. The welfare state is way too generous. You've made that point over and over again in your columns, especially on the school, on the student loans and this craziness that's going on. I mean, if our country is going to be in major trouble if in this election you re-elect a man who is 4 years to, really wreaked havoc on this economy.
But I still don't see, even if we elect the Republicans, I don't see the cuts. I see maybe tax cuts, but I don't see spending cuts. And all if we do, if we cut taxes and get bigger deficits as a result, then it's more money printing, it's more inflation. There is no real will in Washington right now for real meaningful cuts in spending, because all those politicians want to get reelected. I don't care who they are. They're still politicians. They're still going to try to get reelected. And there is no precedent.
Right, but
for
Chris
politicians
Christie is a
acting
perfect.
responsibly.
Chris Christie, your next door neighbor, is a perfect example of a guy who is cutting back and is getting a lot of popular support for what he's doing.
Because he's not cutting enough. New Jersey's still in a lot of trouble.
And it
He
can
needs
be
more
done.
cuts.
And it can be done if you have a Reagan, but as you both said, it doesn't look like we have a
You
Reagan on
need
the
somebody
horizon.
who's very presidential. and
We're
use the
also
whole
out of
pulpit.
time here, guys, but thank you for being for voicing your opinions. It's good that I didn't have to prompt you much to to come out of your
Brian,
shell.
enjoyed it. Thank you.
Thank you, guys. Appreciate it.